There seemed to be a lot of movement, a lot of heat and life, but in the ultimately, it didn't really head in any particular direction, did it?
No, and I think we're in a phase now since we had that very brief pullback last week or the week before. It all blends these days. I think we're probably in a near-term choppy pattern. There's no question that the top of mind for investors, at least those clients with whom I'm interacting, of course, all in a virtual fashion, the number one question is about the perceived disconnect between the market and the economic data. Now, more recently, of course, we've gotten this improvement in the economic data, but I think we have to be really careful about extrapolating that. The nature of this shutdown is such that we're dealing with the law of really, really small numbers. When you compress economic data to such a significant degree, the math is such that the percentage increases off those bottoms is going to look huge. I think the reality is probably more rolling W's as we look out over the next several months. And remember, the left half of a W, of course, is a V. I'm a big believer that rate of change is extremely important. Inflection points are important. But in this case, I think level is important too. I mean, you look at retail sales, a huge bounce, but we're still 40% below where we were. So I think we have to look at the combination of level and rate of change, especially in this environment.
Well, as you say, Liz Ann, even with retail sales were 17% better than they thought, they still are well over year. And then you look at unemployment, well, the claims are coming down, but pretty slowly. There's still over 20 million continuing claims there. So really, how can the market, which is supposed to be discounting future earnings of corporations, say those corporations are going to be earning that much money given what's going on around us?
This is I think, a very classic example of don't fight the Fed. I grew up in this business from 1986 to 1999, working for the late, great Marty Zweig, who coined the phrase, don't fight the Fed. And I think the power of what they have done in this cycle has been seen not just in the equity market, but the calming of credit spreads, which came just with the announcements of some of their relatively new facilities. They didn't even need to be put in place. I think you add to that the relief package, the income support by Congress. We've never seen anything this massive. The combined, you can't really call it stimulus, the combined liquidity and relief equates to more than 25% of GDP. That is extraordinary. And for now, that has been the support. We've had this chasm representing the compression in economic activity, but they've just been pouring money into that to try to bridge us from what was to whatever the post-pandemic norm looks like. So that's the primary reason. And then FOMO, it's momentum driven to a large degree too. So that feeds on itself.
Liz Ann, to oversimplify, is this all good news for investors or bad news? It's good news in the sense that asset prices are being driven out by a lot of money being pumped into the system. On the other hand, are we losing the ability to distinguish good investments from bad investments according to price?
That is, I think, one of the, I suppose, unintended consequences of what the Fed has done. And I don't want to second guess whether we would have been better off had the Fed not taken these extraordinary steps. But there's no question that we do, I'll use a technical term here, muck up the sort of natural price discovery. And I think that not only is a concern in this environment, quite frankly, is a concern that emanated out of the financial crisis as well. So I think we're sort of feeding on those concerns, and that does bother me. Of course, it also contributes to the wealth gap, because when you see lack of inflation in the real economy, but you see massive inflation in asset prices, obviously those on the wealthier end of the spectrum are the holders of those assets. So I think we are breeding some of what came out of the financial crisis as well, and that is not going away anytime soon.
And what about the role of COVID-19, which brought us to this place to begin with? To what extent are the markets reacting to that? We thought this week, maybe we saw rotations going back and forth depending on whether you wanted a stay-at-home stock like some of the big tech, or whether you really wanted to go into cyclicals and things you're thinking about. There's going to be a real recovery here.
I think the virus news around the virus will continue to be, certainly on a short term, even a day-to-day, biggest driver of markets. When you look at the four major headlines that we got on therapeutics and/or vaccines, I think the two therapeutic announcements were back in April, both on remdesivir, and then you got the two initial big headlines on vaccines. I think the first one was Gilead and the second one was Merck. Those 4 individual days accounted for almost 2,700 Dow points. Over that span of time, that was more than the Dow had gained the entire period of time. Fast forward to today, you see the news of the increase in virus cases in some of the southern states, and Apple coming out and saying they're closing stores down in Florida, South Carolina, North Carolina, and Arizona. And if you want to sort of find something to point to why the market weakened during the day, I think that was it. So I think there's no question we are still at the mercy in both directions of virus-related news.
And pick up on that Apple news specifically. Is that a potential warning to other companies, investments in other stocks that say, basically, this is not going to be a straight line up? In fact, we may see other closures. If Apple did it, why shouldn't somebody else, as we have increased problems in Florida or Texas, places like that?
Absolutely right, which is part of the reason why my view of what this recovery is going to look like are these rolling Vs, or rolling Ws, I should say. And I think that there was too much enthusiasm about what seems to be governments at the state and local level, at the federal level, saying we're not going to do a wholesale shutdown again, even if we get second waves. But that doesn't mean that business owners themselves, either large multinational corporations like an Apple or smaller mom and pop companies, aren't going to say, you know what, for the safety of our own community, we're going to shut down. So it fits and starts in the economy is not just a function of the mandates coming down from government. It's the decisions that businesses make and the decisions that consumers make. And I think that's not been mapped out in sort of investor psyche, at least in the more recent period where there's just so much enthusiasm about the recovery.